And we're live. Welcome to the How to Ride the Gold and Silver Bull webinar, a joint production amongst Peak Prosperity, Sprott, and goldnewsletter.com. I'm Adam Taggart, one of the co-founders of Peak Prosperity. I will be your host for today's webinar. So the theme is the precious metals. They have been up big since June 1st of this year. Just in the past couple of months, gold has vaulted from 1275 up to 1561 as of the time of this airing. That's dollars an ounce, obviously. And silver has gone from 1450 an ounce up to 1969. So very big moves in the precious metals. They have been range bound for many, many years, as long-suffering precious metals investors are very well aware. So it's exciting to see them begin to move. But of course, the big gains in this space are not made in the metals themselves. They're made in the companies that mine these metals and the gold and silver producers. And during a bull market in the precious metals mining companies can make tremendous, if not sometimes generational returns. And so we've got some of the top experts in the precious metals mining space here with us today to talk about how you can best take advantage and best position for the coming appreciation in the miners, because even though the metals have started moving and the miners have begun to move as well, the vast majority of the anticipated gains are still ahead of us. And so the whole purpose of this webinar is to help you how to really not screw it up, is the shorthand for how our speakers are looking at things today. There's a lot of ways to make money here, but there's a lot of ways to make mistakes. And so we're going to learn from the very best in terms of how to do this right. Here with us today are Rick Rule. He is the president and CEO of Sprott U.S. Holdings. He's a renowned resource investor. Rick, thanks so much for taking the time to join us tonight.
A pleasure. Thank you.
We have Chris Martenson, who's my fellow co-founder here at peakprosperity.com, macro analyst and futurist. Hey, Chris, how you doing?
Good. I'm happy to be here with everybody tonight. It's going to be a very excellent webinar.
Great. And very happy to be joined as well by Brien Lundin. Brien publishes goldnewsletter.com, very highly esteemed newsletter on the precious metal mining companies. In fact, I believe it's the oldest running newsletter on that space in existence. Is that correct, Brien?
That's correct, Adam, and it's great to be with all of you as well.
Well, thanks. And Brien is also the producer of the New Orleans Investment Conference, which is the longest running investment conference in the world as well. And that's an excellent place to learn about all things related to resource mining companies. And I think at the end of the webinar here, we'll give you a chance, Brien, to tell folks a little bit more about that, because that's coming up in just a couple of months, isn't it?
Absolutely. Coming up very quickly, but there's still plenty of time to reserve your space.
Excellent. We'll obviously let folks know how to do that. So some quick housekeeping rules here, folks. We're going to keep this webinar to a strict 1 hour and 30-minute duration. We know that this is late for a number of you on the East Coast. We want to respect your time. The way it's going to work is that we'll start with Chris. He's going to set the context around this new bull market that's happening in precious metals. And then Rick and Brien are going to get into the details on how to tap into the massive upside potential that's offered by the mining companies themselves. We're going to try to leave as much time as we can for active Q&A with you, the audience. So at the end of after we go through the individual speaker presentations, we'll then launch into Q&A. There are opportunities for you to chime in here. So if you look down at the bottom of your screen, you should see two important buttons. One is for the chat window, and if you can click on that and just type in your name, where you're from. We always like to see and know where our audience is piping in from. And then if you have a specific question to ask, there's a Q&A button there as well. You can click that, pose your question, and I will do my best as time allows to get through as many of those questions as we can. Now, should a presenter get dropped, it happens very rarely, but it does sometimes happen. Don't worry. They're just going to log right back in. The other speakers will certainly cover in the interim. And if you yourself, as a viewer, get dropped, just go back to the email you received from Zoom that had your link on how to get into the presentation, and just click on that link and it should log you right back in. Lastly, I just want everybody to know that there will be a replay video of this live event that will be sent to everybody after it's over, likely at some point tomorrow, probably in the afternoon. So if you can't, for whatever reason, make it all the way through today's webinar, if you have to go pick up the kids, make dinner, you get pulled for whatever reason, don't worry. You're going to get a chance to watch the full event at your heart's content. So with that said, Chris, I'm going to hand the microphone over to you. And if I know, I believe you've got some slides prepared for folks. Do you want to take that part of the presentation away?
Thank you, Adam. Absolutely. Welcome, everybody. Once again, I see that we have people chiming in from Australia, Germany, all over the United States, pretty much every state being recorded in here right now. So thank you, everybody, for joining. Thank you for taking time out of your night to listen to this, because we've got some really exciting times coming. We've been talking about the need for hard assets for a long time at Peak Prosperity. I just want to share a few things with you to set the stage so that we're all talking about and sharing the same data points. I'm going to share my screen here. Adam, you're going to let me know if this actually works for everyone. And
yep, looks good so far. Just enter slideshow mode and we should be good. That looks great.
All right, fantastic. So this is how to ride the gold and silver bull. And what I want to do is, again, just take you through some very basic data. It all begins here. It all begins with what the central banks have been up to. I often say to people, you should keep a journal. These are the most extraordinary times, 5,000 years of human history, and this has never been tried before. What's this? This is printing our way globally to prosperity. It's been tried before, but usually in places like Austria once upon a time, or Zimbabwe, or other places. So what we see here is world stocks, world bonds, all marching up in lockstep with the G3 central bank balance sheets. Those are the three largest central banks out of the OECD countries. And this is across the period of 2016 to 2017. And I put that up there because what we're seeing in the OECD countries is, well, as soon as I can get this to advance a tiny bit. Just one second, everybody, because we need to, there we go. Look at this. This is the total assets of the major central banks. And I've just drawn some very rough, orangish, sort of rectangular shapes in there to show you the area under the curve. And what we're seeing here is how much the central bank balance sheets grew. And when I say balance sheets grew, fancy term for they printed money. They emitted credits out of a keyboard and bought assets. These would be things like treasury bonds, mortgage-backed securities in the United States, or corporate bonds in the case of the ECB, or if you're the Swiss or Japanese central banks, you bought stocks with those as well. So they just printed money out of thin air, bought stuff. And so what we see here is, even as they were talking about in 2016 and 17 that the global economy is recovering, everything's good, unemployment's going down, trade looks robust, behind the scenes they were busy printing up more money than had ever been printed at any point, including the depths of the Great Crisis itself in 2009. And what this gave us was a third continuation in a series, which was the bubble series. So we had a dot-com bubble. The orange line on the bottom is GDP. That's the national wealth. On top of that, you see the actual total collection of asset prices, stocks and bonds mostly, but also real estate. So you can see that there should be some relationship intuitively between the wealth of a nation, what it's producing, and the claims on it. The claims are the asset prices themselves. And so we had the dot-com bubble. It burst. We got back towards that orange line, but the central bank freaked out a little bit, said, no, we're going to drive to 1% blowout rates. They did that. That gave us a housing bubble, as it's called. Really was more than that, but we'll call it a housing bubble for now. Again, that blue line of asset prices got back down towards reality, which is the income or GDP. And they said, oh, no, we don't like how that feels at all. What we're going to have to do is blow another bubble. So this is where we are in this whole story is we have the central bankers bubble, and we call it now the everything bubble because it's everything. Today, this is being recorded here on a Wednesday. And what we saw today in the markets was stocks were up strongly, bonds were up strongly, gold was up, oil was up. What world do you live in where everything goes up in price? Well, a world that's pretty much awash in money or liquidity that's looking for places to go. And this makes it hard to resist. One of my favorite charts showing what happened during the South Sea stock bubble. This was a smallish bubble, big at the time, but small by today's standards, of course. And it spanned just a few years, about 3 years. And I like this one because it shows how Sir Isaac Newton, pretty smart guy, invented calculus, did some really clever things. And he got in early, smart guy, right? And then he got out, and he had quadrupled his money. He should have stayed out, but then his friends were getting rich, and he was going to parties, and everybody was asking him, hey, Sir Isaac, how come you're not in Uber or Netflix? And how much Beyond Meat do you have in your portfolio? Maybe you should have a little Lyft, you know? And it's really hard to resist. Now, I put all these companies up because these are each examples of companies who either have negative earnings or have price to sales that are so extreme, they're almost impossible to justify unless, you know, you're in the middle of a bubble, and then they're really hard to ignore. So yes, you would have been a genius, just like Newton, if you got into these things early. It's always the question of when do you get out of these things. And so I just like to reorient everybody to where we are in these bubble cycles. And by most fundamental measures, this is a chart from John Hussman. He does great fundamental price analysis work looking at value against prices. The top is the line, that blue craggy thing. That's the stock market, and it's comparing that to the gross value add of corporations, which are the red and the green lines down below. So again, you see bubble 1, bubble 2, and bubble 3 all the way over to the right. Stocks by this measure are now the most expensive they've ever been, and that's saying a lot because it's had some pretty strong competition in history. Now, we have some negatives in this story around lots of things around related to debt. Gold has a 90% plus positive correlation with the U.S. national debt. So as you watch the U.S. national debt climb over time, you will see the price of gold climb over time. It's not 100%, but it's pretty tight correlation, been there for decades. So the debt, of course, grows with the deficits. So what I've got here is looking at the deficits. We should hit 25 trillion by 2021 in the United States. Then we'll add another trillion and another and another, you know, just keep adding trillions mentally as you go from 25 to 26 to 27. And this is from the CBO, the Congressional Budget Office. They're kind of positive, more positive than I am, in the sense that they never include the cost of where the deficit will go if a recession comes. It's never an if, it's always a when, and they never factor that in. So if or when we get that next recession, you can take these numbers and probably double them. We'll have $2 trillion deficits. And that's if and only if we don't, in the United States, go to a more left-leaning president on the next cycle and do something like modern monetary theory or some other fundamental printing effort. Now, the real story, though, the one that's really crazy, and I can explain what this is to you, and I can't explain what it is to you, is this idea of negative yielding debt, right? So we have bonds out there globally now with negative yields that have hit $17 trillion. And this means that if you were, for example, going to loan money to the German government, you would have to give the German government $1,000 today in order to get $993 back in 10 years, which means there's no inflation risk, there's no time value of money, there's no entity risk in this whatsoever, and there's no inflation. All of these things are probably not true, but certainly not true over 10 years. And yet that's the world we live in. Again, I can explain it, but I can't explain it. It's really crazy. So one thing I can note for you, though, is that if we look at the price of gold in green plotted against the total aggregate value of negative bond yields, negative yielding bonds, what we see is gold in green, the bonds in white. You can see a very high correlation. And this is not hard to understand, right? So as people are scrambling to buy bonds with negative yields, that is, they're paying for the privilege of being able to lend somebody money. Again, I can explain that, but I can't explain it. If you have now the alternative of saying, well, I could also hold gold, we're seeing gold hit all-time new highs in lots and lots of currencies all around the world. Not in US dollars yet, but in plenty of other currencies. So if you are from one of those other places, if you're in Europe, if you're in China, if you're somewhere where you're noticing that gold is now very high in your local currency, this is the explanation for that in no small measure, right? If you have the alternative of either putting your money into a negative yielding bond or gold, there you go. Just to put another point on this, we have here total negative yielding corporate bonds. This is paying a company for the privilege of lending it money. Again, I can't explain it. That's well over $1 trillion now. So people are so desperate for owning bonds at this point in time that they're willing to have a negative yielding corporate bond. I don't understand what's going on here, but it's never happened in human history before. So keep a journal. Really exciting times. Now, if we look at commodities, though, they're super inexpensive compared to all these other financial assets I've talked about. So when we looked at those bubbles before, and we said assets compared to GDP, those are financial assets. Those include stocks, bonds, and real estate, stuff like that. But for whatever reason, commodities, not part of that story. So if we look at the ratio here in this chart of commodities against the S&P 500, that little green circle on your far right shows that we are at a generationally low price for commodities as compared to financial assets, in this case, equities. So if you're a long-term position investor like I am, there's a great time to buy, and there are excellent times to buy. And this is one of those times if you like to get stuff cheap relative to other things. So this is a really powerful chart that has really informed my own personal investment philosophy here. So let's look at who's holding 0% in gold right now, or pretty close to it. Who would that be? Well, pensions. They have about $10 trillion to invest in the US, and they have virtually none in gold. It's so close to zero, we can call it zero right now. The US public is probably maybe 1 to 3% into gold. Obviously, people in India at a much higher percentage, China as well. But there's a lot of room yet to run, I think, in most of the Western economies here for people, individuals, to get on board precious metals investing. Geez, I always have to toss this one out. The Canadian Central Bank standing out almost as a lone holdout among central banks right now with a big fat zero on its balance sheet. And I threw that up slightly humorously, but also to illustrate that banks are beginning to accumulate more and more gold at this point in time for a variety of reasons. Corporations, their treasury departments are still not, for the most part. I can't find that they have any exposure to gold here at this point in time. And the ETFs, GLD is by far the largest. That's the gold trust. It's got actual physical gold, supposedly, in stated amounts in vaults. In London, that's got today it's got a value of almost 41 billion. We'll call it 40. That's less than 1% of the entire ETF space right now, including ETFs for bonds and stocks like that. So, there's really, at this point, very, very low exposure institutionally and individually on a percentage basis to gold, where if you look at a lot of portfolio analysis that would say, what's the best portfolio you could hold if you were going to have a diversified mix of assets, a 10% or more weighting towards gold is very justifiable by all sorts of risk-adjusted measures, and we're nowhere on that story yet. So what I wanted to do was just give you a little bit of background. I think the big story here right now is the negative yielding debt, because people used to say back to me through all the years I've been recommending gold, they say, gold doesn't yield anything, Chris. That's true, but at least I can say it doesn't yield less than nothing. And that's a big new move in this story. And I think that sets up everything that we need to know about in terms of why this is an area we want to be invested in, and why we need to figure out now is a good time to ride the gold and silver bull. And that's that's the setup I've got for now. Rick, I'm hoping you can make some sense out of any or all of that.
Well, thank you very much for that summary. I love it when somebody else does the big picture. I'm often asked about economics, and I sort of respond that I'm an investor, not an economist. So thank you for that setup. It was wonderful. As part of the rewards that people can claim for watching this video, I have a 40-year Barron's Gold Stock Mining Index that people should look at. I think it's important to note in the context of this bull market where we are in a historical context. And you will see that we are much, much, much closer in a historical sense than to the top. So I want to say that after a 7 or 8 year bear market in the metal, we've had a real bear market in the stocks. Anybody who trades volatile commodities or volatile asset classes know that bear markets are the authors of bull markets. And my suspicion is that this circumstance will be no different. The second thing that you'll note when you look at a long-term chart of gold equities is the incredible upside that's apparent off these cyclical bottoms. A weak recovery is 150%. A strong recovery can be as much as 1,000%. The median recovery, if there is such a thing, is 300 or 400 or 500%. So in the beginning of the discussion about the precious metals equities, you need to know that in a historical context, we are much closer to the bottom than we are to the top. And the upside, if past is prologue, is tremendous. Why is this? Well, a couple of reasons. I can tell you from Sprott's perspective, and we manage, including the recent acquisition of the Tocqueville Mutual Fund Group, well in excess of $14 billion in assets, most of them precious metals related, that the flow of funds into gold is just getting started, but it is in fact getting started. And this flow of funds comes from a very low base. A major US investment bank published a study about a year and a half ago saying that gold's or precious metals and precious metals equities market share of total savings and investment products in the United States was between 1/3 and 1/2 of 1% of total assets, up to about 0.5% now. The 40-year high water mark was about 8%, meaning that precious metals and precious metals related assets in 1981 at the tippy top were about 8% of total investable and savings products in the United States. And the 3-decade mean was about 2%. I'm not one who is going to say that gold is going to win the war against the US dollar or anything like that. I'm suggesting to you that in a gold bull market, that the market share occupied by precious metals and precious metals related equities in the United States will return to its historical mean. What happens if that's true is that demand for precious metals and precious metals related equities just in the United States quadruples. The impact of that, I think, will be extraordinary. And of course, for people on this call, pleasant. Pleasant. Constructing a gold stock portfolio. When you look at the beta in the market, when you look at the upside that's achieved by the market as a whole, what you recognize is that to get good returns, most of what you do is simply capturing beta. For most of your portfolio, you don't need to run after alpha because the alpha takes care of itself. If a poor performing bull market is a 200% gain, simply capturing the beta is often enough. It's important that everybody listening to this call, particularly those who are generalist investors and new to the sector, construct the bulk of their gold portfolio around the very, very highest quality companies. The large liquid companies, the companies that were profitable at $1,100 gold are stupidly profitable at $1,500 gold and almost fictionally profitable at $2,000 gold. Repeat, with most of your portfolio, say 75%, take as little risk as you can. Moving on from there, however, because of course we're all greedy after we've been fearful, the second tier gold producers move later in a market, but they move further. The junior producers, the high quality companies that will go into production. But it's important that if you believe gold is going up or silver is going up, that you focus first on the companies that have gold and silver. Too many people attracted to the gold narrative get themselves involved with the penny dreadfuls who don't have any gold or any silver. They're merely looking for gold and silver. It would stand to reason that if the price of something that you don't have any of goes up, that it doesn't impact you very much at all. So again, construct a portfolio from a position of high quality, then good quality growth, and then, but only then, look after the speculation. The speculations will certainly be the outliers in terms of performance. And the outlying performance in precious metals bull markets are extraordinary. Stories abound over time, but my favorite story goes back to the decade of the 70s when the silver price itself put in a spectacular performance from about $2, if my memory serves me well, to about $50. And that number, my memory does serve me well. While that was a truly extraordinary gain, one little mining company that performed, Coeur d'Alene Mines, now Coeur Mining, went from 10 cents to $65. So the little ones can give you the truly spectacular gains. A shout out to my friend Brien Lundin with the New Orleans Investment Conference. You will see at his conference in October the big companies, the so-called no-risk companies, the growth companies, and also the best of the best juniors. Familiarize yourself with all of them. Understand as an investor, however, that the more risk you take in constructing a portfolio, ironically, the less involved you actually are in gold equities, and the more you are involved in individual companies' performance metrics. Nothing wrong with that. Just be prepared to work harder if you take risks. And also, please capture market beta before you go after individual company alpha. A couple more notes on how to with regards to portfolios. Gold always moves first, but the poor cousin, silver, tends to move further. Gold stocks move in relation to gold, and of course, silver stocks move the furthest of all asset classes, small asset classes. The number of silver companies in the world is fairly small, and the number of high-quality silver companies in the world is probably 10. In a silver bull market, where speculators chase rare goods, that is, high-quality companies, is where you get your most extraordinary moves. And I have found, in terms of constructing speculative portfolios, the tier 3 part of overall precious metals equities portfolios, that overweighting the high quality silver stocks gives you the most alpha with the least risk. Will past be prologue this time? I suspect it will, given the interest that speculators still have in silver and the relative scarcity of high quality silver names. The one other piece of advice, well, I'll give you two more pieces of advice, one for free. The first one is this. High quality people give high quality investment results. Pareto's law is true. That's the 80-20 rule. The truth is that there are a small number of serially successful management teams in the mining business that generate almost all of the performance. Most of the game is buying the best and avoiding the rest. If you associate yourself with serially successful people, people who have been successful over decades in building companies and in investing your own money, and simply avoiding any story that seems attractive that isn't built around a very high quality management team, you will maximize your gains while similarly reducing your risk. The third piece of advice is that the gold and silver narrative, when it begins to work, is so persuasive that you have to sort of give yourself a slap in the face and utilize common sense. If somebody is telling you that the stock of XYZ can go up in the context of some discovery that they might make, it stands to reason to ask them how much money it will take to make the discovery, how much time it will take to make the discovery, and how much money that they have. It's important when you get excited about this sector that you utilize common sense. A shout out to my friend Brien Lundin again. The New Orleans conference has been in place about 40 years. I think I've been speaking there for 32 years now. Perhaps I'm past my sell-by date, Brien. But at any rate, you will have the opportunity at this conference to meet management teams that have met the test of time, people that have made money for New Orleans investors time and time again. And you will have the opportunity to go up to them as presenters and ask them the common sense question that you don't always ask when you read a recommendation in a newsletter or hear it somewhere else. You need to avail yourself of the opportunity to implement common sense, to implement know-who, and to follow these companies well. Do all this, and my suspicion is, given where we are relative to equities pricing levels historically, and how much these markets move to the upside historically, employing these techniques, high quality companies, great management teams, and common sense, it's difficult for me not seeing a circumstance where the majority of the participants on this webinar don't do very, very well. And that's it. Hand it off to Brien or whoever else is next.
No, very inspiring, Rick. Thank you. Brien, I'm sure you've got plenty to share in terms of standing on the shoulders of the giant who just preceded you here. Let's have you jump in now.
Sure. Actually, Adam, no, I really don't.
Okay.
No, in all seriousness, my job here is kind of a cleanup hitter and go over the points that I think that Chris and Rick may have missed if they did miss any. But I have to tell you, I don't think they did. So I think my job here is more to emphasize a few points that they made that I think deserve emphasis. Chris went over the economic argument, and I have to tell people that I approach this whole subject with a bit of cynicism. As Rick knows, I've been involved in the conference business for a few decades, and I've heard some very smart people, brilliant people, in fact, some friends of ours, stand up on that stage year after year and talk about how the end of Western civilization is at hand, how the financial system is about to break up, how the debt bomb is about to explode, and it never happened. So I've seen this over and over. I'm somewhat of a cynic, and so I'm battling this situation over the last couple of years as I look at the numbers, and I watch the numbers every day. I study this deeply every day. And it just occurred to me a couple of years ago that it's to the point now where it's a near mathematical certainty that it's all coming to a head, primarily the debt situation that Chris outlined. Within a few years, the debt will grow so large, and at any interest rate, virtually any interest rate, the cost of servicing that debt will grow so high that we're going to have to borrow money to pay the interest on the debt. At that point, as you can imagine, debt creation grows exponential, and we are within a few years of reaching that point. Chris was showing that chart of the CBO of deficit projections and showing that we're approaching $1 trillion deficits. Well, in fact, we're reaching that this year. Chris, I nearly chimed in there, but you were on such a roll, I didn't want to interrupt you. But that chart, as frightening as it is way out of date. We're going to have $1 trillion deficit this year. And one thing that a lot of people don't realize is that if the deficit is $1 trillion, then the debt actually grows by about $1.5 trillion. That's because there's about $400 to $500 billion of off-budget spending that gets thrown in there, lumped in every year, and it's on automatic. It's on autopilot. It just happens. So the debt is actually going to grow by about 1.5 trillion. And another thing to note is that you see the debt minimized quite often, and by the term debt owned by the public. And that's about 16 trillion as opposed to the 22 trillion in change. That's the total gross federal debt. And the argument there is that the difference is made up of intergovernmental receipts. In other words, one branch of the government owes it to another branch. So we owe it to ourselves, in effect. And the argument there, of course, is that we can always forgive that debt. What they don't tell you is the vast majority of that difference is actually social security debt. And you can't really forgive that. So how are you going to forgive that debt and not pay off Social Security? So in fact, the gross debt is the larger number. The other thing that this implies is that at these levels of debt, we will no longer have anything approaching normalized interest rates. In fact, interest rates have to be ultra low or in fact negative, because the interest costs, the cost of servicing that federal debt are so high, they would crater the budget. If we had rates literally as low or as high as 3%, we could not afford the interest on the federal debt. That has tremendous implications for gold, for silver, for really all tangibles, all commodities, as long as there's some level of economic growth, all commodities. And in fact, equities, as long as, we have some kind of economic stability. But it all goes back to that kind of an easy money environment that we've had that Chris outlined so well. It's created a wealth effect. It's created a house of cards that depends on more and more easy money. The problem, of course, is that if everything is built on this adrenaline of easy money, then nothing is built on a firm foundation of savings, of capital formation. And the problem there is that with each succeeding crisis, with each succeeding slowdown in the economy, the central bankers have to come in with more and greater accommodation, easier money, more quantitative easing than they ever had before, because the patient addicted to this adrenaline needs greater and greater doses to get the same effect. And that's the necessity. And as we come into the next recession, as we come into the next inevitable slowdown, the Federal Reserve really has not much more room to cut. In effect, or in reality, cutting two rates of interest from this point to get to the zero bound would have no economic effect whatsoever. So they will have to return to quantitative easing, and they will have to do that to a greater degree than ever before. Now, what are the implications of this? One is that there is, because of this tremendous debt that we built up, because of the growing deficits, there's an inevitability of higher gold prices. You know, one of the things I stress to people is that this is not new. This has happened over and over again throughout human history. Throughout 4,000 or 5,000 years of history, governments have overspent their means through wars, entitlements, whatever. They have created debts that are unmanageable. So what do? In each and every instance, the prescription is the same. They have to devalue the currency in which those debts are denominated. That's what's always happened. It's what's going to happen again. The difference, of course, this time is that every developed economy is in the same situation. They built the same house of cards. They have created unmanageable debts. So they have to devalue, but they can't really devalue against each other. They are all, in effect, racing to the bottom of the same hill. What does that imply? In turn, that implies that they can only devalue against tangibles, real things. And the foremost of those would be gold and, of course, silver as well. So we have this inevitability of higher gold prices. From drilling down a bit and looking at the markets themselves, the gold market, we see that we've had three legs of the three-legged stool come into play. We've had gold move, which is good, but it doesn't confirm a secular, long-term, sustainable gold bull market. Then that move in gold will outperform gold. That's enough. Finally, about silver start to move, and silver outperforming gold is a third of third leg of that three-legged stool. So,
Brien, it's Adam. I'm sorry to interrupt you. If you could just repeat that last sentence, you froze there, I think.
Yeah, I saw that happening. So, in effect, we have three legs to a stool to confirm a sustainable gold bull market, and those three legs are gold moving, gold mining stocks moving, and then silver. All three confirmations have come into place. So we can see now that we have confirmation of a sustainable long-term gold bull market. Now, the opportunity that faces us now goes back to what Rick was saying. A lot of these junior mining stocks and mining stocks in general have yet to move. So there are still tremendous opportunities that avail us, tremendous opportunities in the market right now. Yes, they have moved. Some of them have moved 30, 40, 50%. In Gold Newsletter, we have one of our picks that's now up 26 times in price. But the point is that it's still early. There are a lot of companies that have yet to move, a lot of new opportunities that are being created. And what investors need to do for their own sakes is to get involved in this market. You know, if this is anything like the early 2000s market, and Rick alluded to this as well, the average gold stock goes up. And if you look back at the high in 2011, the average gold stock is up is down to about 1/4 the levels it was in 2011. So the average stock, according to the major indices, will go up 4 times in value. But the more highly leveraged, the better mining stocks, and getting further down the food chain, the more highly leveraged junior companies are going to do much, much better. You know, looking back to the early 2000s, we were able to find a lot of companies that soared to multi-dollar levels when they were still penny stocks. Northern Dynasty comes to mind. I think that went up about 30 times in our portfolio. The list goes on and on. I apologize, I'm forgetting some of them. But another point that brings up is that within that bull market, as it progresses, there are going to be many bull markets. You know, we had and Rick remembers this well, we had a uranium mania at one point, or uranium bull market within a larger scale gold bull market. We had a rare earths bull market. We had copper plays and base metal plays take off. There were a lot of opportunities that evolved over time. And these were, in effect, each of these were opportunities where people could multiply their money. And really, that's one of the primary things I stress to people is we're in a situation right now. You have an identified bull market. You have another close to generational opportunity to make money, and you have to give yourself a chance to do that. One of the ways to do that is to take the time and the money and the effort to educate yourself. Go to conferences, subscribe to the best newsletters, go to these events and look the companies face to face. Ask them hard questions. And again, one of the keys is to take money off the table along the way. Rick can attest to this. You know, one of the things I remember Rick saying during the last bull run was that he sold something every day on general principle practically. I don't think he's doing as much of that lately in considering the valuations out there. But don't forget to take money off the table. When I say take money off the table, I don't mean just leaving it in cash in your brokerage account because you will be enticed into the next story. Take it out of the brokerage account. Sorry, Rick, but get it into illiquid, income-producing investments if possible. But again, we're talking about an opportunity where companies will go up 2, 3, 4 times in value. You can take profits from that, or have a liquidity event, or take money off the table and you invest it in another stock that goes up 4 or 5 times. And somewhere along the way, you're going to have a 10-bagger. And if you're lucky, you may have one that goes up 20 times in value or so. And this goes on and on over a period of years. That's the kind of opportunity that's facing us right now. And that's the kind of opportunity to build, yes, generational wealth, if you play it correctly. And the first step in that journey is getting involved now in the top stories while they're still at what will be at some point in time, seem to be bargain levels. And with that, I will hand it back over to you, Adam.
Great. Thank you, Brien. So we're going to start digging into the questions, folks. Again, I see folks are posting in the Q&A tool there, but if you've got a question and haven't asked it yet, that's where you should do it. Brien, I'm going to direct this first question to you, and then Rick, I'll give you a shot at it too. One of the most common questions that has been coming in is sort of, you know, how much of the opportunity lies ahead of us, right? The metals have made a big move already. You know, before listening to what you just said there, Brien, they're really reiterating how early we still are. I think there was a fear that folks might have already missed the party bus already. So as you look to the scope of the opportunity here, let's use a baseball analogy. If you had to pick which inning we're in terms of this new bull market, in terms of the appreciation potential, what inning would you pick?
I would say the first, actually. I mean, if you look back, the bull market really began in December of 2015. But we had about a 6-month run. Then we pretty much traded sideways in gold since then. And the junior mining companies, and really the mining companies in general, started declining back toward their lows. But I do believe we are, if you look at the length of what I expect this bull market to be. We are in the early innings. And yes, some of these stocks have gone up 40, 50%. Some have doubled or more. But that's more a function of where they were and how undervalued they were, how cheap they were, than it is of how far they're going to go. If you look at the charts over the past 3 months, and in the last issue of Gold Newsletter, we feature a lot of 3-month charts of our recommended stocks, and they all are going powerfully from the lower left to the upper right. But those are 3-month views. And if you pulled back and looked at the grand scheme of where they could go, and in fact, where those very stocks have been, even in a moribund market, they have tremendous room to run. And we're talking about potential for considerable multiples of where they are now. And again, there will be new stories to emerge. And the key is to get in on those new stories early in their development.
Great. Rick, anything to add?
Sure. 3 comments. The first is I've been through 3 really strong, counting this one as really strong, cyclical markets in the metal. 1970s, the metal ran from $35 to $850 an ounce. Pretty good move. Now, admittedly, the $35 was from a price control base. In 2000, the gold price had declined back to 250 from 850. Outlook for gold was horrific. And it marched from $250 to $1,900 over the next 10 years. So if you look at the potential magnitude of this bull market against the price performance of gold in the last 2 cyclical markets, you'll understand just how far that it can go. And if you look at it in the context of negative real yields, what Jim Grant calls return-free risk, I think what you begin to understand is that not only can it go, it probably has to go. But now let's look at the equities. Brien made a great point. The TSXV resource index, the junior index, fell over 7 years in a nominal sense by 86%. They gained the index, so the real loss was 90%. A stock that doubles has gone from a 90% loss to an 80% loss. That'll tell you something about the potential upside in the sector. Now, that doesn't mean that it's going to go straight up. In fact, the market that we're in right now is a wonderful market. It's grinding higher, not peaking higher. Markets need to back and fill. The market that you're seeing right now is extremely healthy. But this market can fall by 10%, just like a person can inhale and exhale. A speculator needs to be prepared for market declines in cyclical or secular bull markets. I remember back in the decade of the 70s, you'll recall, as I just said, that the gold stock went from, the gold price went from $85 to $850. 1975, the market had gone from $35 to $200, and people were full of the narrative. And then the market fell by 50%. Most of those stalwart bulls got shaken out. And as a consequence of getting shaken out, they missed a move from $100 to $850. This will be a volatile market. You need to be prepared financially, and you need to be prepared psychologically for the volatility that will occur. But make no mistake, as long as we have negative real interest rates, as long as we have debts that exceed the national income, the stage is set for a very, very powerful bull market. The important thing for investors to do, because the magnitude of the market is so great, is just minimize your mistakes. Just be in the game. Don't chase the wildest stories. Buy the best of the best and ignore the rest.
All right. So I've got a whole series of questions to ask. I'm going to continue with you, Rick, but I'm going to pull the other experts in as we go. So Rick, I think you very rightly emphasized the volatility of not just the precious metal space, but the slice of it that the miners exist in, which is much more highly speculative than the base metals themselves. For the average person, and hey, this is not personal financial advice, but sort of what percent of somebody's portfolio, I don't want to say percent, but what part of somebody's portfolio should they allocate to the miners? And that means, let's say somebody has they bought the argument about negative interest rates and all the debt, and it's probably only going to get worse and worse. They want to have exposure to the precious metals. I assume there is a core holding of metals you want first, and that probably starts with some physical metal you own yourself. Maybe you own a little bit more stored for you somewhere, whatever. But you're kind of creeping up the scale here, and each level becomes a little bit more risky, but a little bit more higher promise of return. Where in that pyramid do the miners exist? And should people be using only money that's speculative, that if it went to zero, it wouldn't decimate them? Or how do you advise somebody to look at the capital they put into the very volatile miner space?
Well, I advise someone's physical gold holdings to be the most secure form of savings.
Yep.
Insurance. And we ask clients in this market to hold at least 10% of their portfolio in physical gold. And by the way, hope it goes down in price. You never want your insurance policy to pay off. With regards to the gold stocks, I think you put them in two buckets. You have your hell or high water stocks. Things like Franco-Nevada, the companies that are enjoying 50, 60, 80% profit margins. That can go in the growth part of your portfolio, a non-speculative part of the portfolio. The alpha, the thing that attracts people to a webinar like this, really needs to be in the part of your portfolio where if you lose your courage and get shaken out, you can afford to lose half your money. Now, that number is going to vary from person to person. There are lots of people in the world who will take a risk at losing half their money in hopes of making 1,000%. And it's not a bad investment decision, but you need to be psychologically and financially prepared to take that risk. It's very important that you right-size your investment. There is no one answer that fits all investors. I once remember Doug Casey writing me a mock complaint letter because I had been too conservative with his account. And he said under the SEC Know Your Client statute that I was violating my affirmative duty by not taking enough chances with his account. That's a case, I guess, of knowing your client. But really, the answer to the question has to do client by client by client. One critical mistake that I'd like to get in this discussion here is that most clients own too many stocks. If you're going to own speculative stocks, you have to follow them and you have to beat up your broker. You really have to know these things. And so we ask clients to have a portfolio that by way of number corresponds with the number of hours per month they are prepared to spend doing things like going to the New Orleans Investment Conference, reading proxies, reading press releases. If you're willing to work 20 hours a month, then own 20 stocks. If you're only willing to work 10 hours per month, then you can only own 10 stocks, I would suggest to you. Work hard with your advisors. Don't just take what they say for granted, but make them explain why. At this point in time, I should point out that in the attachments to this conference, in the offers from the speakers, I've offered every attendee here an absolutely no obligation resource portfolio review. Send me your whole portfolio, names and symbols in text, all rank them. Now understand, that's a snapshot in time. That's right now. It'll change over time. The important thing is right-size your portfolio, right-size your technique, invest in your own education, and keep working, keep studying this material. If something goes wrong with a stock, don't think it's going to get back to the price you paid for it by some sort of magic. When the reason to own a stock goes away, make the stock go away. Sell it. Trim your mistakes.
Lots of great advice in there. I really like the kind of rule of thumb, have an hour per month committed to each stock that's in your portfolio. A couple quick rapid fire questions for you, Rick, and then I'll bring the other guys in. First off, we've had a couple of questions as you've been talking, both earlier and just now, to just differentiate or explain the difference between beta and alpha. I don't think every listener fully understands those.
Beta, very broadly defined, Chris is going to laugh when he hears my definitions because he actually knows what all this means. Beta basically is capturing the bulk of the market move, participating in line with the sector. Alpha means you're trying to outperform the sector. You're trying to pick stocks that do better than that particular market segment as a whole does. My point in this simply is that there is so much volatility in the gold mining stock sector that if you just capture the up move in the market, that you will have done well enough. You don't have to take extraordinary risk to capture alpha in a market where the market moves are as dramatic as they are in this move. Did I get close, Chris?
That's good. Yeah, that's very good.
All right, this one is a bit of a softball, but one of the recent questions we just had here, because Rick, you've been saying, do your research, do your homework, follow some of the top newsletters on the precious metals miners. What are some of the top 2 to 3 best newsletters on the miners to be following?
Well, at the risk of insulting some of my best friends by leaving them out, I would say the most venerable letter in the sector, if you care about gold mining stocks, is probably Gold Mining Stock Report. I think Brian's letter has certainly stood the test of time. I also like Exploration Insights. I believe that Brent will be speaking in the New Orleans conference. An analyst of long standing, we believe he was very well brought up because he worked for us for 7 years. That would certainly be a good start. But it's important also, I think, as Brian suggests, that you go to these conferences and you listen to 7 or 8 editors yourself, so that you can figure out an editor whose paradigm, whose method of communication and teaching makes sense to you. This isn't a one-size-fits-all game. For me, I often like very wordy communications and people who sort of challenge me. For other people, they want branded conclusions from people they trust. So again, just as one stock or one portfolio doesn't fit all, one editor or one newsletter writer doesn't fit all either. Most editors give you the ability to see some of their work before you have to buy it, and certainly avail yourself of multiple opportunities to do that.
Okay.
If I could chime in there, Adam, Rick's been in this market so long, instead of gold newsletter, he referred to it as Bob Bishop's old newsletter, going back to the 80s.
Sell by date, Brian.
Exactly. So it's goldnewsletter.com. But a couple of others I would add there would be Gwen Preston's letter, Resource Maven, Eric Coffin's letter, Hard Rock Analyst, and Lobo Tigre has a new letter. I think it's International Speculator.
That's right. Excellent letter.
Yeah, and all 3 of those, in addition to Brent and Joe's letter, Exploration Insights, are really good. And we also have a report on our website, a free report that details all of the best letters out there and all of the conferences, in addition to the New Orleans conference. And yes, Rick, your conference is listed in that report.
Great. I'll remind folks too that in addition to the offer that Rick extended a few minutes ago of the free portfolio review, Brian is sharing his 2 of his top precious metal mining picks from goldnewsletter.com with the audience of this webinar as well. And that will all come by email to all of you watching, along with a replay video, which will come out at some point tomorrow. So a question for you guys as well that's come up here. Some people are asking, what's the difference for somebody who is maybe a little bit more conservative? What would your feedback be for somebody who just is kind of looking at the major funds, the major mining funds, versus owning a basket of, say, 10 to 15 individual majors that are being picked by an expert?
I personally believe if you're not willing to do the work, that you can and should invest in the funds. And in that instance, while I would prefer, of course, that everybody bought the Tocqueville Fund, which is managed by Sprott, owning an ETF, a low-fee ETF, and capturing the market beta is probably sufficient. My objection to that is that I guess I know by personal experience that too many of the big companies that populate the funds are junk. And I would prefer that my clients owned a highly focused group of 5 superior companies rather than a low fee product of 35 companies, 16 of which we know to be inferior.
Well put, Brien.
I would add to that. I completely agree with Rick. If you absolutely have to invest in an ETF, the most popular ones are GDX and GDXJ, the GDXJ being supposedly the junior mining companies in the index, but it's become so popular that they've had to upscale their equity holdings to where there's very little difference between the two. I prefer, as a longstanding gold bug, the gold bugs index. The HUI is the symbol. It is comprised of gold mining companies, producers that don't hedge more than 10% of their production. Now that's an issue that's no longer an issue right now, but it will return at some point. These mining companies will want to return to their status or take on a status as industrial companies rather than mining companies, wherein they're exposed to the gold price. You don't want that if you want to invest in gold. The reason that gold mining companies hedge their production, in effect, they sell future years' production for today's prices, is because they want to preserve their positions in the C-suite. They want to preserve their jobs and keep a steady stream of revenue coming in. You don't buy these companies for steady streams of revenue. You buy these companies for extraordinary streams of revenue when the gold price rises. So I prefer the gold bugs index, but a more actively managed portfolio like Tocqueville, which has a long and stellar history, as does Sprott, would be a great option in my view.
All right, that's a great piece of insider feedback on that.
Adam, can I add on to that? Because I have a question I'm just dying to ask here. And this goes to Brien and or Rick. So I invested in a lot of mining shares back in 2008 up through 2010, 11. And one of the things that caught me then was there was a lot of, shall we say, I was unhappy with management discipline. I saw a lot of dilution going on, this hedging that you just talked about, things like that. So I'm wondering, is there anything different this time than last time? Tell me about how the gold companies may have changed their management, or have they, between then and now?
Brien, you or me?
Well, I'm going to disagree a little bit with Rick, so I'll let Rick go forward. Go first. Retain that advantage of the high ground.
The last decade, the decade of 2000 to 2010, saw mining companies, even by their low standards, exhibit very poor management skills. And the consequence of that was that the mining companies collectively, in terms of write-offs, managed to lose about $70 billion in shareholders' funds. The consequence of that was that more than half of the management teams that existed then were allowed by their investors to pursue other employment opportunities, which has been very good for the business. Mm-hmm. My suspicion is that as the bull market gains teeth and free cash flow increases, really as a consequence of the increase in gold price rather than as a function of management genius, that the bad habits will return. And it's important, I think, that gold share investors, like any other investors, at a very minimum, read the proxy and read the annual report to determine whether or not their management teams are sort of recidivist or are in fact first tier. The problem is a bit worse with the juniors. Doug Casey likes to say that the managers of many of the juniors, were there not for a stock market, would wear a mask and a gun when they went to visit the 7-Eleven. And you need to be even more vigilant with those companies. There are circumstances, we saw one today, where the CEO's salary is 45 times the value of the stock that he owns in the company. What that really means is that he doesn't particularly care where the share price goes, because he won't get any increase. All he's interested in is maintaining his salary. There are other circumstances where shareholders are interested in takeovers, of course, so management teams put in a change of control feature where they get paid well if the company is sold. What that really means is that they have an interest in driving the share price down to the point where it's cheap for another company to buy them so that they can get a bonus that's worth 5 times their salary and walk away. Your question is a great question, Chris, and it requires absolutely constant monitoring. It's worth monitoring, however, given the money that you can make in the upsides in these companies. Big profits aren't supposed to be free or easy.
Now, I said I would disagree a little bit with Rick, and not too much, because Rick's absolutely correct. If you're going to invest in the larger producers, you want that to be a well-managed company. And Rick has been one of the people advocating and evangelizing for reform of management principles at the big miners. And I completely agree with that if you're going to invest in the big miners. As someone who focuses more on the junior mining space, number one, I think a lot of that is tilting at windmills, because human nature being what it is, they will inevitably start spending money like drunken sailors on mining projects and building reserves, resources, et cetera, at the peak of a bull market. And as someone invested in the junior mining sector with hopefully projects they want to sell to the big miners, I hope that those big miners are spending like drunken sailors, and I hope that they're mismanaged to some extent and buying the projects that I'm invested in. So I take a bit more cynical view of it, of the market, and it may be the only time I out cynical Rick, but I think that inevitably, to put a finer point or a broader point on it, human nature being what it is, at the top of a bull market, you're going to see a lot of stupidity and insanity. And if those mining companies are repeating what they have done in the past, they will, if you're invested in the right juniors, make you a lot of money.
All right, Brien, that comment is a really good segue to this question, which kind of goes to the heart of the theme of the webinar here, which was how not to screw this up. Right, we're hopefully being granted here only once or twice, or maybe in Rick's case, said this is the third bull market you've seen, 3 times in a lifetime opportunity to go on a ride like this. Just as important as what you buy and when you buy is the selling part of it.
Right.
So I'd love to hear your guys' thoughts on. Nobody rings a bell at the top. So when does it start making sense to exiting your gains if people make smart decisions after this webinar, end up sitting on some gains over the next couple of years?
Well, I'll start off with that, because we'll leave it to Rick to cap it off, because he is the best seller I've ever met in this market and the smartest one at it. But in general, if you're looking at when to sell, it's not at the top. You will never sell at the top. You'll never be that person that brags at cocktail parties afterwards in the bear market that you sold at the top. That person largely does not exist. So what you need, when you need to sell, to be a bit facetious with it, is always. You always need to be reevaluating your portfolio and taking profits out of the market. And again, what we're talking about is not the typical kind of investment opportunity. What we're talking about are stocks that typically multiply in price and create new opportunities. So with something like that happens, you need to occasionally stick a ladle into that flow of capital gains and pull it out of the barrel and put it into something that you cannot redeploy very easily into the market. That said, you also need to reevaluate each position. And Rick, I think we'll get into that in a bit more detail. You need to have a reason to buy each stock and make sure that they still fulfill those reasons. So I'll hand that one off to Rick.
I would suggest that one benchmark in terms of a gold bull market would be if you saw the real yield on the U.S. 10-year Treasury exceed 250 basis points. If the stated CPI rate of inflation is 1.6, and the yield on the U.S. 10-year Treasury is 150 basis points, obviously there's no incentive to trade out of gold. If you saw the CPI at 2 and you saw the yield on the 10-year at 3.5%, I think you'd start seeing some disintermediation from gold into the Treasury, irrespective of the rest of the narrative. So that would be the broad number that you would look like, that you would look for. Note that the rate of inflation, the CPI rate, and this is a whole different discussion, is grievously understated, but that's a different circumstance. The second thing is, and this is going to sound really cynical, but don't think of it too badly. When you begin to think that you're smart, when you begin to think that you understand this sector, and when you really begin to think that this sector is a good sector, then you need to begin to sell. The truth is that this is an extremely cyclical sector. You will have a circumstance, I suspect, in this bull market where some of your mistakes double. And when you get rewarded for making a mistake, it is time to really, really, really de-risk the most speculative parts of your portfolio. It doesn't mean that the market can't continue to go high. I remember very well one of my favorite clients, the mentor of Brien Lundin, the late Jim Blanchard, would occasionally call me and he'd say, you know what, Rick, I've made more money than I deserve to have made. Sell some stock, send it to me, and I'm going to take it and get it out of harm's way. Those are really, really good instincts. What happens to us as a people is that our expectation of the future is set by our experience in the immediate past. Von Mises called it, of course, recency bias. And price experience justifies paradigm. That's why bull markets go so high and bear markets go so low. When you begin to experience a circumstance where the price realizations that you have seen justify the narrative that caused you to buy the stocks to begin with, or where you begin to think that you understand this market, that you have this market, that this is a good market, begin to take money off and put it someplace where you're ironically less comfortable.
All right. Well, very well said. One last question sort of on this topic. For those folks that are realizing the wisdom of leveraging the expertise of these newsletter writers, right? People that can follow these companies, talk to the management, maybe even go out and tour the mines and whatnot. I'm sure there's variety in the industry, but are these newsletters more or less saying, here's some companies we think are good and here are companies we think are bad, and sort of make up your own decision? Or do any of them kind of provide a tracking portfolio where they say, these are the 10 that are in our top 10 portfolio, and we're adding this one this month, and we're getting rid of this one for this reason? How does it tend to work in that industry?
My experience has been that the best newsletters may or may not have a tracking portfolio, but they certainly follow companies. And if they sell, they explain why they sold. They explain, we took a profit here, or our expectation wasn't met, and the lesson that we learned here, you know, the lesson that we learned as a consequence of that loss is explained here. I know that Exploration Insights and the speculator, Louis Lobo's letter, both do have sort of documented portfolios. Many newsletters don't.
Okay, great. All right, so another question that's popping up a lot here is people who are, I think, attracted to the precious metals right now because they're increasingly skeptical of all the other alternatives out there to invest in, notably the stock market and most likely bonds as well. But the question that's popping up here is, hey, if I believe that the stock market is likely to experience a major correction soon, what do you guys expect to happen with the mining shares? Are they going to be treated as stocks and go down with the market? Will they buck the market trend? And of course, I think some people are remembering back in 2008, 2009, precious metals initially were sold as we began sliding into the financial crisis, I think largely because anything that wasn't nailed down was getting sold to meet margin calls. And then they recovered and, of course, zoomed up to the heights that they hit in 2011, 2012. But what is your guys' best guess as to how the mining companies will be treated should we indeed go through another major contraction in the equities market?
I would say it depends on the nature of that. If you look back at 2008, that was liquidity crisis, a credit crisis. And gold, yes, was sold. It was the piggy bank that was broken open to meet margin calls. It was a ready source of liquidity, and in effect, it served its function. It served its role very well in that instance. But if you remember, it would drop $100 one day and be up 100 or more the next day. And these were very short-term events. The mining stocks after that credit crisis, even as QE was just starting, actually underperformed the metal for a couple of reasons. One is that the price of oil was high, and therefore these miners had high costs of production because those big yellow trucks use a lot of oil, a lot of energy, a lot of fuel. And the other reason is because no one wanted paper in any form. They actually wanted the physical metal. So gold actually outperformed the miners. If we have a situation where the Federal Reserve and central banks flood the markets with liquidity, I think as long as we don't have a liquidity crisis or kind of a credit crunch, then you'll see the mining stocks perform well. But if there is a major crash in equities in general, the mining stocks will suffer as well.
I would echo that. It's important to understand that in the near term, gold stocks are stocks. And if you have a psychotic break in the equities market, a type like you had in 1987, 2000, 2008, initially the gold stocks sell off. The measures that are usually taken to correct those manic sell-offs are usually very good for both gold and gold stocks. But remember that if you have a psychotic sell-off, a break, particularly one that's a consequence of a liquidity squeeze, that the sell decision isn't often made by the individual speculator or investor. It's made by the margin clerk. And the margin clerk will sell what has a bid. So you need to be prepared psychologically to hold good equities, not just gold equities, but good equities through psychotic breaks. If you understand something about the value of your holdings, you will be less disappointed by the price action in the near term in a decline.
All right. So that then goes to the follow-on question that people are asking on this topic, which is, then is it wiser to wait to put most of your capital into this space if you believe that lower stock prices are ahead for the general market, wait for some sort of correction, and then get into this sector versus beginning to get in now? I'm sure you guys have strong feelings on this, but just sort of share your general advice to people here.
I think it depends on who you are. I would say if you have no exposure to gold and gold stocks, given the story that the 40-year chart from the Barron's Gold Mining Stock Index shows, that you need to have an exposure. I would suggest for generalist investors that they start with the higher quality companies and move down the quality chain later. If there are people that have an existing portfolio and they want to be cute, they want to look for a better entry point, by all means do that. But my suspicion is that we are early in a gold bull market, and the gold bull market has multi-innings and a lot of recovery in front of it. And I wouldn't want to see people uninvested in the gold space unless they had the rest of their sort of portfolio taken care of in the same way that gold can.
Got it. Sounds very wise. All right here. Well, folks, we are getting a ton of questions, but we are getting very short on time. I'm sorry that we're not going to be able to get through all of these, but we definitely have done our level best. Let's see here. I'm just trying to think if there's any quick one that we could end on here. Just curious if you guys have any thoughts on this, all three of you. People are saying for stocks that may have a huge appreciation like this, is there any advantage to either owning them through a taxable brokerage account or in a tax deferred or tax free account like some of the retirement accounts out there? Is there any particular preference or logic, or is it all just up to the individual and their particular goals and situation?
I believe it's up to the individual, their investment advisor if they have one, and their tax advisor if they have one.
Okay. All right, and with that said, you talked about investment advisors, so let's get into the special offers that each of our expert speakers are offering to everybody who's watching this webinar, whether you've registered and are watching live, or whether you're watching this on the replay video on YouTube or through some other channel. So Rick, you just talked about the importance of working with advisors. You have, I think, extremely generously just invited people to send you their portfolio allocations, and you will respond, or you and your team will respond with a ranking of their investments. Did I describe it correctly?
That's absolutely correct. If people will email their natural resource investment portfolio, it's important to put both name and symbol in the text. We will rank them from 1 to 10, and we will comment on some individual issues where appropriate. We will also include in the return email that Barron's Gold Mining Stock Index, the 40-year chart, that, as I say, tells so many stories about where we are and where I think we're going.
Excellent. So just to be crystal clear for folks here, email you their natural resources stocks. You don't want to get their entire portfolio. You're not going to comment if they have Tesla or Lyft or Beyond Meat or whatever.
And even if I did, you wouldn't want to take my ranking seriously.
Okay. Now, Chris from peakprosperity.com, we have a recent piece that you wrote, a premium piece that you wrote on how both gold and copper, they're sending the signals they're sending are diametrically opposed to one another, but both signals together are basically indicators of approaching crisis. So we have that piece, and we also have a long primer that we offer on just helping people think through the general options of buying gold and silver if they're actually new to that space. But Chris, anything to add about the crisis piece that you wrote?
Well, absolutely. You know, one of the reasons that I'm a very inveterate holder of gold, I've been holding and accumulating, I haven't sold a single ounce since I started accumulating in 2001, is because of those charts I put up showing that the central banks are doing something really historic and probably dumb. And I think this ends in a monetary crisis, and gold, of course, is the only asset I know about that functions as money that's not simultaneously somebody else's liability. That's why when Rick said, hey, you got to have your gold insurance, and you actually, this is the one piece you hope doesn't actually pay off. I don't want it to pay off either, but I think everybody needs to understand the signal that gold is sending at this point in time. And it's why we contrast it with copper, and you look at the gold-copper ratio, sends a very interesting set of signals. It says, we're getting a little worried on the international side about the monetary situation and framework, and we're not so confident about the actual global growth opportunities at this point in time. So they can send separate signals, but when you put them in one spot, you get the same signal, which says exactly what we saw back in 2008. So this is a period of time where we're absolutely going to want to be holding gold through the turbulence that we think is coming, and that's a function of all the printing that's happened out there. So we decode that for people in that piece.
Excellent. And then Brien, publisher of goldnewsletter.com, you are offering 2 of your top picks from your current newsletter that you'll be sending to folks, correct?
That's correct. My fellow panelists have served up a 3-course meal here, and I go straight to the dessert. I have a special report that I give new subscribers to Gold Newsletter that details my top 10 picks at any point in time. And I've taken from that top 10, 2 of my best picks that I think are more appropriate to a general audience that have tremendous upside potential, and reveal all the details, give the stories of behind each company. And they can get that through this free offer. Now, that said, I don't want to de-emphasize the results in this space. You know, you look at these companies. Am I back?
Now
you are.
Okay, good. Sorry about that. So I don't want to de-emphasize the value of doing the research on your own. Even after you get this report, look into the companies, do your own due diligence. But also, again, go to conferences. I surely hope you'll come to my New Orleans investment conference, November 1st through 4th, and meet me there, meet Rick, meet Chris and Adam, and a number of other experts in the sector, in really every investment sector. but go to conferences in general. Go subscribe to the best newsletters, devote the time and effort, because this is the kind of opportunity you cannot let pass you by.
Excellent. And Brien, in our follow-up to folks, we'll provide a link to the New Orleans Investment Conference as well, so folks can learn more about it and hopefully sign up if they feel like it's a good fit. So as we wrap up here, I just want to do a couple of quick reminders. Everybody who has registered for this webinar, whether you're watching us live right now or not, will get a copy of the replay video, as I mentioned. In that email that sends that replay video to you, you'll also get links to all of those special offers that each of the experts just mentioned. If you're somebody who didn't sign up for the live webinar, didn't register for it, but is watching this video on replay, either on a website or on YouTube or whatnot, you can still get access to those special reports as well. If you go to peakprosperity.com/golden offers, that's all one word, golden offers. You'll be sent to a page where you can just type in your email address and name, and we will email you those same special offers that the experts just talked about here. And hopefully when you're watching this on a replay video, you'll have that URL up on the screen, so it's very clear to you on how to get there. With that being said, we are at our closing time here. Each of you three speakers, Chris, Rick, Brien, I want to thank you so much for taking the time tonight to go into such depth on such an important topic. I know I'm speaking from folks from seeing the comments here. People are incredibly energized by getting a sense for how early on that we might be in this historic opportunity here to ride the appreciation potential of this space. And I know we got a lot of people here that have probably been sitting on precious metals for a long time and have the scars and the scrapes and the emotional trauma to prove it. And it's just wonderful to finally be at a time in this storyline where optimism is creeping in. And I think you've just lifted off the lid in terms of how optimistic folks can maybe get about the future. So thank you for doing that. Thank you for sharing your expertise. And I hope we get to do something like this again with you all again soon.
Thank you, Adam.
Thanks, Adam. Thanks, everybody.
All right.
Folks. Thanks again for watching, and keep your eye out for those emails that we mentioned. Take care.
Thanks, everyone, and goodbye.